Costs ranges for funds can vary wildly. I've seen funds that cost upward of 2% a year and funds that cost less than 0.05% per year. Well, on 100 grand invested, that's the difference between paying £50 a year or £2,000 a year in fees. Which would you rather? How do you optimize the fees that you're paying for the funds that you are investing in? And by optimize, we really mean reduce, right? When we're investing, there are very few things that we have direct control over, but we do have control over one of the biggest factors governing the returns on our investments. Let's get into it. Hi and welcome back to the channel. Yes, the charges that we pay for our investments are one of the biggest things working against our future wealth. If you invest some money for 25 years, say, the difference between paying a 2% and a 1% annual fee means that you give up more than a fifth of your potential pot. So we need to understand these costs and we need to keep them under control. And I'm going to show you what you need to look for. Remember, as usual, there are chapter markers along the bottom of the video so you can skip to the piece that interests you the most. Right, let's get to it. There are charges at each of the 3 levels of the investing chain. So what are those levels? Firstly, at the lowest end, we have assets. Then we have platform and wrapper level. And then finally, up here, we have the advisor level, which may or may not apply to you. Okay, let's start from the bottom up and talk about asset costs. Most of us use funds inside of our pensions and our ISAs to spread risk and benefit from economies of scale. If you're buying individual shares or other assets, then there probably won't be any charges at that level. But if you're using funds, there will be. Now, you might think that this will be an argument in favor of buying individual stocks rather than funds, but I would say not, because the benefits of the funds are worth their cost, in my opinion. Also, if you're buying individual stocks, there will often be stamp duty to pay, which generally doesn't apply with some funds. Now, with funds, you will hear various 3-letter acronyms bandied around when talking about costs. There's the AMC, the annual management charge. Also, you might hear of the TER, the total expense ratio, which is a complete con because it isn't total expenses and it isn't a ratio. The one you're looking for is the OCF, the ongoing charges figure. All funds must quote this figure to you before you buy them, and you'll find it clearly described in the fact sheet of any fund that you're looking to buy. That's not quite it though, because all funds have incidental costs on top of that, usually called portfolio transaction costs. And funds disclose these explicitly too, and any illustration that you get before you invest will include them. Numbers are usually fairly small for these extra costs, and weirdly, sometimes these incidental costs are negative. So they actually reduce the other charges. I have literally no idea how that's possible, but I don't care. I just want to know the whole figure that I'm paying. Worth mentioning that if you're buying a property fund, then these incidental costs are often much higher. Costs a lot more to buy and sell property. And they are usually grouped together in a charge called the property expense ratio. So look out for that. Costs ranges for funds can vary wildly. I've seen funds that cost upward of 2% a year and funds that cost less than 0.05% per year. Well, on 100 grand invested, that's the difference between paying £50 a year or £2,000 a year in fees. Which would you rather? How do you optimize the fees that you're paying for the funds that you are investing in? And by optimize, we really mean reduce, right? Well, in fund management, expensive does not automatically mean better. In fact, the reverse is true in the vast majority of cases. Expensive funds are actively managed with a highly paid fund manager and teams of analysts that need to be paid. Lower cost funds are usually passive, which means that they track markets rather than trying to beat them, and that's cheaper. Given that the majority of active managers underperform their markets over pretty much any timescale, I think passive investing is the way to go. And you should be able to buy a decent passive fund for 0.25% a year or even less if you want one where everything is done for you. a kind of portfolio in a box. But if you want to put together a collection of ETFs, which are a special kind of passive tracker fund to build your own portfolio, then you could potentially pay 0.15% per year, maybe even quite a bit less. So don't pay for active fund management, at least not for the core of your portfolio. Look for passive funds instead and decide how involved you want to be. You'll pay slightly more for a done-for-you portfolio than you will for one that you put together yourself. And don't ever use a fund where there is an initial charge, sometimes called a bid-offer spread. Fortunately, these are pretty rare these days, but they do still exist, so watch out. Okay, let's move up a level to platform and wrapper charges. Most of you watching this will know what a platform is. It's simply an online admin system that allows you to manage your investments yourself. A wrapper is simply an account. It's a box in which you hold the assets or funds that we were just talking about. A pension is a wrapper. So is an ISA, a lifetime ISA, or a GIA. By the way, we call them wrappers rather than accounts to differentiate them from bank accounts, which are absolutely not the way to build wealth. Now, platforms charge in one of two ways, either a percentage charge based on the amount that you're investing, or a fixed cost, usually paid monthly. If they are charging a percentage, then that might be tiered. So with more invested, the cost reduces accordingly. There may also be a cap. Vanguard do this. They charge 0.15% on anything invested, but cap the fee at £375 per year. So if you do the maths, that means that if you have more than £250,000 invested, you're not paying any more above that. A percentage charge is likely to be better for smaller portfolio sizes, whereas a fixed fee is likely to be better for larger portfolio sizes. So bear that in mind. Watch out for incidental costs on your platform too. There might be dealing fees, for example, when you buy and sell an asset. That's not really a problem if you're buying and holding, but if you are trading regularly, then those costs can rack up. Some platforms are basically a done-for-you service like Nutmeg, Wealthify, PensionBee, and others like them. So here you might just see one overall cost that covers the platform cost and the underlying investments. Though usually if you dig in a bit, you will see the breakdown. And you're not usually choosing the underlying funds on these services. Instead, you choose an investment approach, a risk level, and the actual investing, the choice of funds underneath, is all done for you. Some platforms will charge you per wrapper, per account. So you might pay £10 a month for an ISA and another £10 a month for a pension. Interactive investor charge like this. That's super cheap for large holdings. Finally, at this platform and wrapper level, look for admin or transaction fees for things like moving a pension into drawdown or for transferring to another provider. Your pension might be free while you're saving into it, no wrapper charge, but it might then have charges when you start drawing off it. Optimizing at this level is simply about understanding what your needs are and then finding the best fit. So if you're an active investor who loves to buy and sell individual stocks, you're going to want a different platform from somebody who wants to buy and hold one passive portfolio fund forever. So determine how you want to engage with your money and choose accordingly. There are loads of options out there, so take your time to choose the right platform for your specific needs. I have a couple of links later on that will help you. And finally, we have the costs of paying an advisor. Now, I will repeat here a message that I often put out on this channel and on the podcast. Most of you can do perfectly well without ever needing a financial advisor. There are so many great resources out there these days that if you have the will and the time to learn, you can understand all the ins and outs of the personal finance system and make great choices for yourself without paying an advisor. Of course, many people don't have the time or the inclination, so they are paying an advisor. Now, on an ongoing basis, most advisors charge a percentage fee based on the amount that they are looking after for you. This shouldn't be more than 1% a year, and you can do better than that. As with all costs, you need to question the value that you're getting for it. So if you have a really engaged financial planner who meets with you regularly, is really responsive, is always on hand when you have decisions to make, then you're probably getting good value. They should be making you more money through tax planning, decent investment management, and behavior management than they are charging you in fees. over the long term. But if you have an advisor that you haven't heard from in 3 years, you really should not be paying them just to sit on your money and do nothing. By the way, if this is happening, your advisor is breaking the rules and you really need to challenge them on it. You can find advisors who work on an hourly rate or on a fixed monthly retainer. Again, it's about working out what's best for you and your situation. Advisors might also charge you admin fees or implementation fees if they're executing a new piece of business for you. In my view, you shouldn't be charged twice for transacting the same money. So if your advisor recommends something now and then 5 years down the line wants to charge you to move that same money into something else, then I would be resistant to that. One exception to that might be crystallizing pension money, as that's quite a pivotal moment and requires some big changes. There's often quite a lot to do at that point. Any decent advisor should separate planning fees from implementation fees. Planning is where all the skill is, but the weight of our regulatory burden is at the recommendation and implementation stage. So that's a little bit back to front. But to optimize the fees you're paying for an advisor, firstly, ask yourself if you're getting any value from them at all. If not, you should just sack them, or at the very least, negotiate a fee which you deem to be good value. It's your money you're paying them, remember. Maybe you can find an advisor that will charge you a fixed fee for a piece of work with no ongoing costs or responsibility towards you. I'm seeing that advisors are becoming more and more flexible in the way they work in response to changing customer demands, and that's a really good thing. Again, determine what you want from the relationship and find an advisor that will work the way you want for a fee that you're prepared to pay. Make sure that they hold up their end of the bargain for the long term. Like all aspects of our finances, fees and charges are something we need to be intentional about. It's really easy to forget about them, but consider this. Costs compound over time. If you invest £100,000 and get a 6% return, say, the difference between paying 2% per year in fees versus 1% per year over 30 years is £108,000 in returns. That's over 100 grand thrown away in unnecessary charges. That money is much better in your pocket than in the pocket of your fund manager, your platform, or your financial advisor. Now, as promised, in the description, I've put a couple of links to help you compare platforms at least, so you can start to apply some of this stuff for yourself. Okay, folks, that's it for this week. I hope it was useful. We certainly covered a lot of ground, I'd say. If it was helpful, then please hit the like button and subscribe to the channel if you haven't already. Thank you in advance for that, and I'll see you in the next video.